You just received a $10,000 bonus. Do you invest it all today or spread it out over the next 12 months? This is one of the most debated questions in personal finance. Lump sum investing means deploying all your capital at once. Dollar cost averaging means investing fixed amounts at regular intervals, regardless of price. Let's define these two strategies precisely. Lump sum means you invest the entire amount on day one. Your money is fully exposed to the market immediately. Dollar cost averaging splits your investment into equal portions over time. If you have $10,000 and invest monthly, that's about $833 each month for 12 months. The key difference? With DCA, your average cost per share depends on price fluctuations. When prices drop, you buy more shares. When prices rise, you buy fewer. This is sometimes called the DCA advantage. Watch how this works in practice. As the share price fluctuates, each monthly purchase buys a different number of shares. Your average cost ends up lower than the average price. Now let's look at what the data actually says. Vanguard's landmark 2012 study analyzed markets in the US, UK, and Australia going back to 1926. The result? Lump sum investing beat dollar cost averaging about 2/3 of the time across all three markets. On average, lump sum outperformed by about 2.3% over 12 months. Why does lump sum win more often? The answer is simple. Markets go up more than they go down. The S&P 500 has delivered positive returns in roughly 75% of calendar years since 1926. Every day your money sits in cash, waiting to be invested, it misses out on expected positive returns. Lump sum captures more of the market's upward drift because your money is invested longer. Let's simulate this with real math, starting with $10,000 invested in a market averaging 8% annual returns with 15% volatility. The lump sum investor is fully invested from day one. The DCA investor gradually builds their position over 12 months. Watch how the gap between them develops. But here's where it gets interesting. DCA shines when markets crash. If you invested your lump sum right before the 2008 financial crisis, you lost nearly 50%. A DCA investor buying through the crash had a much lower average cost. In the 1/3 of periods where DCA wins, it typically wins during market downturns and high volatility environments. DCA acts as a natural hedge against bad timing. Let's compare the risk profiles. Lump sum has higher expected returns, but also higher variance. DCA has lower expected returns, but provides a smoother ride with less regret. Think of it this way. Lump sum maximizes expected wealth. DCA minimizes maximum regret. The right choice depends on which objective matters more to you. So, what should you actually do? If you can handle volatility and have a long time horizon, lump sum is mathematically optimal. But if a big drop right after investing would cause you to panic sell, DCA protects you from yourself. There's also a middle ground. You can invest a portion immediately, say 50 to 70%, and DCA the rest. This captures most of the expected return advantage while reducing timing risk. Let's recap the key takeaways. Number 1. Lump sum wins about 2/3 of the time because markets trend upward. Number 2. DCA is not an inferior strategy, it's a risk management tool. Number 3. The best strategy is the one you can actually stick with. A perfect lump sum plan you abandon after a 10% drop is worse than a DCA plan you hold for 30 years. The real enemy isn't DCA versus lump sum. It's not investing at all.